Hi, this is Sean here. Thank you for taking the time to watch this video. This is a quick tutorial video on a template that I've created a couple months ago when the new tax laws changed regarding assessed losses that are rolled over for companies. This came into effect essentially the 31st of March 2023. I came across a really good article which I'd like to share with you. There is a link on the template to this article where you can refer to the examples that they provided when they released this article. So quickly go to the website where I found this. This is on Mandak. The contributor was Nexia SNB and T. Thank you very much for this contribution. 27th of February 2023 was the release of this article. And basically what it does is it gives you the new rules, when is it applicable, and how will it impact the previous rules when applying the different scenarios. So firstly, what I'd like to just explain is when does the new rules come into play? Obviously now we are toward the end of 2023, so it's obviously applicable now. But for those who are unfamiliar with this, when they're doing their tax planning going forward for their company, it is just important to know. The new rules apply for any year of assessment that began on the 1st of April 2022 onward, and that ends on or after the 31st of March 2023. The new limitation applies to company assessed losses balanced as the 1st of April 2022, and not only to assessed loss accumulated after this date. Companies do not lose the balance of any assessed loss that could be utilized in one tax year. It is just carried forward to the next year. And a few other rulings over here, and this is just a few other implications here. Just note, smaller companies with taxable income below 1 million are not affected by the rules and can still deduct the full balance as an assessed loss against 100% of the taxable income. So that's what you could have currently done up until the new dates. So essentially the new rule says, under the new rules, an assessed loss can only be offset against 80% of taxable income or 1 million, whichever is higher. If it's under 1 million, does not apply. You still apply the old rules. Over 1 million, 80% of taxable income, which then you roll over based on that. So whichever is higher in the relevant tax year, with the remaining balance still rolling over. So you still roll over, but you still have to pay tax on 80% of gross taxable income, and then that will then be paid, and then you roll over the balance. Obviously, in the previous years, company losses could, subject to certain requirements, be offset against 100% of taxable income in the following year, with any balance rolling over to subsequent years. So there's some nice examples here, which I'd like to just go through, just to illustrate what that means practically. And then I'll just correlate that against my template. So the template here has been designed to basically mimic this because it's very well explained, and it just allows you to put any values in here. So in this case, it's 1,500,000, for example, 1, and 3 million for the assessed loss brought forward. So the assessed losses obviously is greater than taxable income, so you are going to have a rollover to the next financial year. Because it's above 1 million, so it's 80% of 1.5 million, which is 1.2. Then you take 1.5 minus 1.2 is 200,000. That's the amount that you're going to apply the tax in the company, which is 27%. So 81,000 is what you're going to be paying to SARS, and you roll over with 1.8. That's important because obviously, if you're rolling losses over relative to taxable income, what is the tax going to be paid in that year? In this case, obviously 81,000 for a taxable income of 1.5 is not bad. But bearing in mind, on the previous tax rules, you wouldn't have paid any tax because your assessed losses is greater than your taxable income, which you can see over here. So in this example over here, 1.5 million, 3 million is the assessed loss. It's 100% of taxable income. So assessed loss deducted 3 minus 1.5, so 1.5. And you roll over with 1.5, you make your loss, so there's no tax. Very straightforward. If we go to the second example, which is 4 million taxable income and 3.5 million assessed loss, now you can see the taxable income is greater than your assessed losses, which means that in the old rules, you would have had 500,000 taxed at 27%. Very straightforward. In this case, it's 3.2 million because it's 80% of 4 million. 4 million minus 3.2, 800,000. 800,000 is the amount that is taxed at 27%. So the tax paid is 216,000, and you roll over with 300,000. Now, in this case, because you're making taxable income, which is greater than assessed losses, you roll over with nothing. So it's really a catch-22 because you're paying 216,000 in tax and you're rolling over with 300,000 into the next year. So if you're an accountant, you can strategically do that, where you can maybe run losses that are higher or try and generate certain profits to bring down your tax. But in this particular case, 216,000 is what's paid, which obviously is higher than the 135, which is on the 500,000. So that's just really important to note because you need to have that money available to pay SARS in that year of assessment. If we go to a larger number now, which is 30 million and 31, obviously your assessed losses is greater than your taxable income. So it's 80% of 30 million, which is 24 million. 30 minus 24 is 6. 1.6 is the 27% of 6 million. And you roll over with the balance, which is obviously 24 from 31, so which gets you to 7. Now, in this particular case, this is quite important because if you apply the old tax rules, as I said, the assessed losses is greater than taxable income, so there's no tax paid on the old rules. But on the new rules, it's 1.6 million, but you roll over with 7 versus rolling over with 1 because your assessed losses is 1 million higher than your taxable income. So again, it swings and roundabouts because you can roll over higher, but you have to pay tax in that year of assessment. So it does get a bit tricky because you need to have cash flow to pay that 1.6 if you are making losses greater than turnover. And of course, obviously, if you're talking about really large turnovers, let's say it's 750 million, and you're running over with 800 million. So let's say it's a huge corporation now. That's the difference. You're now paying 40,500,000 in tax, which you are rolling over with 200 million. So obviously, one just has to be aware when you're doing the calculation. Now on the converse, let's just show you quickly on this example. If it's under a million, let's say it's 900,000, and you're running over with 1.2 million, then you will apply the old rules because it says it's a million or more, whichever is higher. So quite simply, you're going to roll over with 300,000 because you've got 300,000 losses that are great, that are greater than your 900,000 taxable income. The only real scenario I've really struggled to do in this template because there's so many balancing formulas to get it to work, and there's also explanations over here depending on which scenarios you choose, is if you have a case where you've got 900,000 taxable income and you've got 800,000 assessed loss. Now, very logically, you're going to have 100,000 taxable, which in theory, you're going to pay 27% on 100,000, which is 27,000. I've tried to factor in this template, but there's so many formulas that are running based on the different scenarios. But in this case, if it's under 1 million and your assessed losses is less than your taxable income, you apply very basic accounting principles. If it were a million, then you'll apply the 80% of the million or whichever is higher. In this case, it's a million. So it's just the one permutation that was difficult to factor in terms of the calculation, which is where your taxable income is higher than your assessed losses and it's under the 1 million threshold. So just apply the 27% on the 100,000 as you normally would do, and you'll just use this template for other scenarios, as you can see over here. I've created a link to this particular article. I know there are other articles which use exactly the same tables. Welcome to use those, but it amounts to the same thing really at the end of the day. But It's just nice for you to know if you're doing some tax planning and you've got a company and you want to know if my turnover is over R1 million and I'm making certain assessed losses, let's say 1.2 million. Let's say let's make it 12 million and you've got 5 million. And now you've now do the calculation for the new year. You now need to make provisions for 648,000. In this case, balance forward will be 4.6 million because obviously you're gonna roll that over. So yeah, I hope this template can add some value to those who are just looking to get a bit more advice on how the tax applies to different scenarios. Again, as I said, you can just use this template however you please. But essentially what we're saying is that you can use this template to make your life a little easier when you're doing those calculations. Yeah, so you can download this template, use it. Have any questions, welcome to drop a comment. But if you go to the article and you just apply the scenarios, different examples, it should be fairly straightforward for you to grasp the concept. And then reach out to an accountant that is obviously doing the tax returns for companies if you'd like to have a consultation. We do have the facilities if you would like to. Just drop a comment and I can then put you in touch with a financial manager who can help you with any tax related questions. Thanks for that, and hope to create some new templates, upload new templates in the near future. Thanks.